What if I told you the retail crowd is completely wrong right now? Everyone is panicking because we saw a massive drop down to the $60,000 level. But if you look at the underlying market structure, institutional capital is actually front-running the next leg up. Welcome back to Crypto Yield Pro. If you are holding Bitcoin right now, or if you are waiting on the sidelines for a deeper crash, you face a critical decision. In this video, I'm going to show you exactly why that bounce at $60,000 was not an accident, and why the $67,000 level is the absolute line in the sand for the mining industry. But here's the critical part. The data flashes a warning sign that we could still see $53,000 before we break out into price discovery. I'll break down the exact invalidation levels, the macro environment, and my personal risk-adjusted strategy so you do not get chopped up in this volatility. Stick with me, because the data we are about to review changes everything. Right now, Bitcoin is hovering right between $70,000 and $73,000. We are basically sitting in a structural no man's land, chopping around after a violent test of our macro support. If you look at the sentiment over the past 2 to 4 weeks, the market has been completely bipolar. One day, we are celebrating institutional inflows, and the next day, a geopolitical headline sends the entire crypto ecosystem into a massive tailspin. But this is exactly why this video matters right now. We are at a historic crossroads for capital preservation. When you filter out the noise and look strictly at the data, a very clear picture emerges about where the smart money is positioning itself for the rest of 2026. You see, the average investor is focused on the hourly candles, getting completely chopped up by short-term volatility. The sophisticated investor is looking at the macro environment, the liquidity cycles, and the fundamental catalysts that actually drive price over a multi-month horizon. Personally, my crypto portfolio is strictly structured to handle this exact environment. 65% allocated to Bitcoin and Ethereum, 10% in Solana, and 25% in other altcoins. This allocation keeps me anchored while capturing upside beta. But there is something in the technicals that changes this picture entirely, a confluence of indicators we have not seen in years. Before we get to the chart, the fundamentals tell us exactly why this $60,000 level is defending so aggressively. Let us look at what is actually happening beneath the surface, because the on-chain data is screaming structural accumulation. First, we need to talk about liquidity, because liquidity is the absolute lifeblood of any bull market. Just recently, stablecoins printed a massive $3 billion expansion in just 7 days. That brings the total stablecoin market cap to a new all-time high of $314 billion. That's the largest expansion since October. This is not retail money buying $20 of Bitcoin on a mobile app. This is institutional capital loading the gun, preparing to deploy. And we are seeing that deployment in real time. Since the beginning of the month, Bitcoin exchange-traded fund net flows have reached roughly 18,000 Bitcoin. This marks a sharp contrast with the previous 4 months, all of which ended with brutal net outflows. The big players are accumulating again. But what makes this accumulation phase so unique is the broader macro environment. We have escalating geopolitical tensions right now. According to real-time Polymarket data, the cost of the special military operation in Iran has now cost United States taxpayers in excess of $11 billion and $300 million. What happens when the government spends money it does not have? They debase the currency to fund the deficit. And how did markets react to this exact event? Over a 60-day period following the February 28th conflict escalation, the S&P 500 was down 3%. Gold was down 4%, but Bitcoin was up 14%. We are witnessing the real-time decoupling of Bitcoin as the premier asymmetric safe haven asset. The supply side of the equation is just as bullish. If you look at the sentiment data, Bitcoin's percentage of supply on exchanges is down to the lowest levels since November of 2017. Coins are being aggressively moved to cold storage. Investors are treating Bitcoin strictly as a long-term store of value. We are facing a severe supply-side liquidity shock. any marginal increase in demand will trigger a disproportionately aggressive upward price squeeze. When you combine this supply shock with the fact that Bitcoin is currently deeply oversold relative to both gold and global liquidity on a historical standard deviation basis, the setup becomes explosive. Both of those Z-score indicators have crashed to -2 standard deviations. Historically, these zones represent heavy structural accumulation rather than distribution. Mathematics confirm the asset is heavily discounted. Furthermore, Google Trends data comparing average search interest shows that Bitcoin is crazy early compared to oil and gold. Retail attention is demonstrably low. The lack of mainstream search volume confirms we are not in a retail-driven blow-off top. Looking at the Bitcoin Power Law full price history and projections, the model projects parity with all gold by 2035 and parity with global real estate by 2050, reaching $20 million per coin. We have massive runway ahead of us. Now, let us zoom out and look at the chart, because this is where the fundamental thesis meets the reality of price action. Looking at the Bitcoin weekly chart, we have massive confluence right now. A few weeks ago, on February 3rd, I shared a specific chart with my free Telegram community, marking out resistance and support levels for precise buy and sell points this year. At that time, the price was still sitting up at $77,000. I clearly marked $60,000 as a downside target. A few days later, the price dropped exactly to my $60,000 mark, which triggered a buy limit order for me, as I mentioned to the group on February 8th. After that perfectly executed bounce at $60,000, you can see where the price was violently rejected, exactly at $74,000, which was the exact resistance zone I had also marked on that chart. So, why is this $60,000 level so absolutely critical for the macro environment? To answer that, let's move to the monthly chart. If you look at the logarithmic growth curve, we just perfectly tested the multi-year ascending trend line. Historically, every single time we touch this support since 2017, it marks the macro bottom before a parabolic run. Right above that trend line is the purple cloud, which represents the Bitcoin cost of production. Currently, that mining cost sits at roughly $67,000. Holding price above this level is incredibly important for market structure because it keeps miners in profit and prevents structural sell pressure from capitulating operators. However, I'm heavily bullish only if this $60,000 bottom confirms. Let me be very clear about my position strategy. We do not front-run the indicators for new entries. It's currently mid-month, and the Fibonacci Relative Strength Index Momentum Oscillator is getting oversold. But it's still pointing down. The bullish curl has not happened yet. To actually confirm the long-term bullish trend, we need a monthly candle close above $79,000 to completely engulf the previous close. That's the invalidation level for the bears. But what if I am wrong? What if $60,000 was not the actual bottom? If Bitcoin breaks below $60,000 and loses that multi-year ascending trend line, $53,000 should be the next level down. That's exactly where I have got another limit buy order waiting in case it drops. I'm prepared for the bearish scenario too. For further downside risk management, the cumulative value coin days destroyed metric is currently sitting at roughly $47,000. Historically, this has been one of the most accurate bottom price forecasting metrics, establishing our definitive worst-case scenario macro floor. Meanwhile, the 10-year realized price chart screams to accumulate and wait on easy mode. We are resting right on top of generational accumulation zones. So, what's the strategic outlook? How do we synthesize these fundamentals and technicals into a practical game plan? In my honest opinion, $60,000 was the bottom, but I could be totally wrong. And that is perfectly fine, because capital preservation means preparing for all probabilities. My strategy here relies entirely on patience. If that $60,000 to $67,000 support zone holds on the monthly close, and we secure that engulfing candle above $79,000, my macro Fibonacci extension targets are locked in for the next 12 months. Target 1 is 100,000, Target 2 is 126,000, and Target 3 is $167,000. These are mathematically derived upside objectives based on historical market structure. But if we fail to hold, I'm ready to deploy capital at $53,000. You must let the chart decide the outcome. So, the convergence of institutional ETF inflows, record stablecoin liquidity expansion, and a textbook test of the macro mining cost of production suggests the bottom is in, provided we hold the critical $60,000 structural support on the monthly timeframe. Don't forget to always protect your downside, map your invalidation levels, and let the data guide you, not your emotions. If you found value in this data-driven, risk-adjusted approach, please hit that like button and subscribe to the channel. It signals the algorithm to push real, objective analysis over hype. For those who want faster daily updates and real-time market structure breakdowns, I invite you to join my free Telegram group. We have over 180 members in there right now. The link is in the pinned comment below. Remember, nothing in this video is financial advice. This is simply my personal strategy and perspective on the market environment. Finally, if you want to understand how these macro liquidity cycles are currently affecting the Oracle sector, I highly recommend you watch my last video about Chainlink. Thank you for watching, stay disciplined, and I'll see you soon in the next one.